Oil just surged nearly 30% in a single day. Gas prices are heading toward levels most Americans have never seen. And if the war in the Middle East keeps escalating, experts warn this could get dramatically worse. This isn't just a geopolitical story anymore, it's coming straight for your wallet. On Monday, Iran launched a fresh wave of missile and drone strikes, this time aimed directly at energy infrastructure across the Gulf. The markets reacted instantly and violently. Both major global oil benchmarks, West Texas Intermediate and Brent Crude, surged close to $120 a barrel in one of the largest single-day price jumps in years. European natural gas prices also spiked roughly 30% on the same day. And zooming out, since this conflict began, WTI has surged over 75% and Brent more than 60%. Let that sink in. Oil has nearly doubled in price since the first bombs dropped on Iran. That translates directly into higher prices at the gas pump, higher heating bills, higher costs for airlines, trucking companies, and manufacturers, meaning higher prices for virtually everything you buy. G7 nations held emergency talks about coordinated releases from strategic oil reserves, which slightly eased the surge, but the underlying fear in the market hasn't gone away, and as long as missiles keep flying over the Gulf, it won't. Iran isn't just firing at military bases anymore, it's going after the energy heartbeat of the global economy. In Bahrain, Iranian strikes hit the Al Mamir oil facility, causing a fire and significant structural damage. The state-owned energy company Bapco declared force majeure, a legal term used when extraordinary circumstances make it impossible to fulfill contracts. Translation: Bahrain's oil and gas exports are disrupting indefinitely. Qatar and Kuwait's energy producers issued similar force majeure notices, signaling that Gulf crude and liquefied natural gas exports are at serious risk of further interruption. This is precisely why markets are panicking. The Gulf region supplies roughly 1/5 of the world's entire oil output. When energy infrastructure in Bahrain, Kuwait, and Qatar starts getting hit, the ripple effect reaches every economy on Earth. Asian stock markets tumbled on Monday as investors fled, reflecting just how exposed the global economy is to what happens in this narrow strip of the world. To understand the full picture, you need to know what these benchmarks actually mean, because not all oil is the same. The two prices you hear about most are Brent Crude and West Texas Intermediate, or WTI. Brent comes from the North Sea between the UK and Norway. It's light, low in sulfur, and easy to refine, making it the global standard that prices roughly 2/3 of all internationally traded oil. WTI is America's benchmark, produced mainly in Texas. It's actually even lighter and higher quality than Brent, and it trades on the New York Mercantile Exchange. Then there's Urals crude, Russia's main export blend. It's heavier, higher in sulfur, and harder to refine, so it typically trades at a discount to Brent. With Russia already under sanctions, and now Iran's oil infrastructure under attack, two of the world's major oil-producing nations are essentially offline for Western markets simultaneously. That supply squeeze, combined with a choking of the Strait of Hormuz, through which 20% of the world's oil travels, is the perfect storm driving prices toward $120 and beyond. Iran isn't just fighting a military war anymore, it's fighting an economic war, targeting the pipelines, refineries, and shipping lanes that keep the global economy running, and so far it's working. Oil at $120 a barrel is painful. Oil at $150 would be devastating. The question now is whether diplomacy can intervene before the energy markets reach a breaking point. Subscribe and hit the bell for daily updates, and drop a comment. How much are you already paying at the pump? Let us know where you're watching from.